Good afternoon, everyone. How are you guys doing this afternoon after the break? Okay, so it's a pleasure to be here. Myself, in a nutshell, I am an MSF alumnus. I was part of the MSF full-time number 20 cohort, graduated in 2017. Okay, exactly 3 years ago, I was in your shoes enrolling in this class. So it is surreal how I am now running the workshop that I once participated as a student, an opportunity that would not have manifested without the generosity of Atan Kanit. I'm also joined today by Punim. Okay, she is also an MSF alumna, part of the MSF Flexible 10 cohort. Okay, and we'll be here to cover the second half of today's lesson with you. Over the next 1.5 hours, we'll be dissecting and forecasting the financial performance of the Aero One Group, or simply Aero One. Okay, the company operates hotel businesses in Thailand and abroad, specifically the Philippines, under multiple brands from JW Marriott and Holiday Inn to Novotel, Mercure, and Ibis. Okay, the company also generates revenue streams from other business segments, including rental property and property management. Before we get our hands dirty and punch formula into our workbook, I'd just like to establish expectations with all of you. There are 4 objectives that I strive to accomplish with you by the end of today's workshop. The first objective is to recap with you how to analyze past financial performance of a company. Okay. The second objective is to give you a flavor of how financial forecasts can be done. The emphasis here today is not on debating the reasonableness and appropriateness of our assumptions, but rather it is tilted towards equipping you with the nuts and bolts of financial forecasts and financial modeling so that you can use them, okay, this skill set and knowledge as a building block for your future assignments in school, at work, and beyond. Okay, there are a couple of issues to consider when you work on financial forecasts and financial modeling. The first factor is the nature of the business, all right, how you would go about forecasting revenue streams for a renewable power producer will be different from how you go about doing one for a retail business or a airline business. Okay, another factor that is of concern is the amount of information you have. Okay, the more information you have about the company's finances, the more detailed your model can be. All right. The third objective here is to show you how to tie the 3 financial statements, and last but not least is to give you a flavor again of how a best practice model can be done. All right. So if you have any questions at all while I speak, please raise your hand. There's no point to wait until the end of the session to have your questions entertained. All right. So before we begin, I'd like you all to go to File. Okay, it's at the toolbar. Go to File first. Go to Option if you can. I just want to make sure that we have the technicality settled. Okay, so once you're on here, I want you to click on Formula, which is the second line. Okay, the second option. I want you to take out Enable Iterative Calculation. Okay, take this out for the time being. Okay, so on this pop-up, you should not have a check on this Enable Iterative Calculation. All right, just to make sure. Once you get that done, you click OK, and you will return to the main page. Good? Okay, now I want all of you to go to tab Historical. Okay, tab Historical, we'll work on this first. Okay, can you see the screen just fine? Do I need to zoom to 100%? Okay. Actually, can we use this also?
Yeah.
Okay, so I don't...
The volume is a bit less loud, so let's see.
Hello? Okay, can you all hear me? Okay, very well. So on this tab, okay, I want to show you how we structure our model. Okay, so we have the dates at the very top, all right, and they run from old to new. As you can see, we have 2016, 2017, and 2018 at the top, all right. So these are the 3 periods where we will be analyzing the financial performance of Aero One. Now, financial items are being positioned top down. Okay, so if you scroll down, you will see all the financial items. Okay, revenue, profit, okay, balance sheet items, and whatnot. Okay, capital expenditure, common size, etc. So this is how we go about structuring our model. This is a basic picture of how our model looks like, or how a spreadsheet looks like. We have and these financial items, they are being grouped into sections. Okay, so you can see that you can actually group this, so you can hide this. Okay, key analysis, and you will be faced with profit and loss. Okay, you can also open this again, in case you want to use it. So this is good in the sense that you don't want your model to be too long. Okay, you can just close the sections that you are not using while you are working on your model. Now we have key analysis at the top. Okay, we have key analysis at the top, and this is our output. Our output. That means that we will be working. Okay, we will be doing our calculation work on this right hand side. Okay, this is so these blanks represent the cells that we'll be putting our formulas in. Okay, we have output at the top. If you look at profit and loss segment or section, you will see that this is our historical data. This is our input. Okay, so we have input, we have process, and that's calculation, and we have output up here. This is my personal preference. You could also do it the other way around, where you can have input first, so you have input at the top and you have output below. To me, I just think that for this purpose it's easier. Okay, it's easier to navigate by having our output at the top. When you do modeling, okay, and when I say modeling, it's not catwalk. Okay, I got a lot of people ask me, hey, what do you do for a living? And I say, I do modeling work, and they go like, oh, wow, they got really excited. Okay, when we say modeling, we are referring to financial modeling in this case. When you do financial modeling, I want you to think of cooking. Okay, take instant noodle, for example. Okay, if you want to cook instant noodle, you have instant noodle as an input. We have, I'm not sure if our international students have had instant noodle, but they're really nice if you want to give it a try. Okay, so we have boiling water as our process, and then we have a bowl of instant noodle as our output, right? So financial modeling works the same way. You have financial data as your input, you have your working and formula as your process, and that's what we'll be doing, and then you have your resulting computation as your output. Okay, so far so good? Now, we have two sets of data, all right? We have profit and loss statement, and that is the second section right here. We have the balance sheet data, okay, and that is over here is the third section, okay, row 74 onwards. And we have additional information, okay? This is something that we also need to make our financial projections. We have capital expenditure and dividend payment. For now, well, I took the liberty of calculating common size for you. So, but at this time, we do not need it. You can also just minimize common size, profit and loss, and common size balance sheet. Okay, just so that you don't have to scroll too much. All right. For analysis, okay, let's talk about the first section. For analysis, it is my personal preference to group my analysis into 6 categories. Okay, so growth, profitability, okay, solvency, liquidity, efficiency, and working capital requirements. Okay, you could also do this other ways. Okay, but this is my personal preference. Now let us work on each item line by line. Okay, revenue growth, right? How would you go about calculating growth? It would simply be new minus old over old, right? And that equals new over old minus 1. So equals, you go to your revenue, and that is the second, that's in the second section. Okay, you divide by the previous number, and you minus 1, and you got 6.6. Okay, you do the same for gross profit. Okay, and now as I speak, you can do the rest. Okay, I'm sure you can figure this out. So gross profit, we would do the same, just apply the formula to different numbers. Gross profit right here, okay, over, I'm sorry, this minus 1. Okay, do the same for EBITDA. Minus 1. Okay, do the same for EBIT. Minus 1. Do the same for net income. Minus 1. Okay, do the same for cost of goods sold. SG&A. Okay, and other income or expense. All right. So once you got all these, you could just highlight them. Okay, so you press Shift and arrow down to highlight them. You Control C, you press Shift and right arrow, and you press Enter. Okay, so basically you are just copying the formula over to the right hand side. Again, you just highlight the cells. Okay, you Control C, you press Shift and right arrow to highlight to drag to the right, and you press Enter or Control V. Okay, both will give you the same outcome. So far so good. So everyone got that done. All right, over to column F. Here we want to. Okay, so over here we want to summarize. Okay, growth rates. We have growth rates over the 2 periods. We want to just use one figure so that we can then use this figure to forecast future financial performance. And here we use CAGR, okay, compound annual growth rate. All right. Some people call it CAGR. Okay, so if you are tired of saying CAGR, you just call it CAGR. Okay. It's like WACC, weighted average cost of capital. Some people call it WACC. I don't understand why they have the patience of calling it the full name, WACC. Just call it WACC, right? So we call this CAGR. Now, when we calculate CAGR, so CAGR is a geometric mean, right? It's different from arithmetic mean. And usually we use geometric mean and not average mean. Can anyone explain why is this the case? Why do we use geometric mean rather than arithmetic mean? Anyone? No one? I think you've learned the difference between geometric mean and arithmetic mean, right? So the reason why this is the case, okay, is because let's say we have period 1, 2, and 3. Okay, you have 100. This is revenue. Go from 100 to 200, and then it goes back to 100. Okay, so if you find the growth rate, you will have 100% growth rate in the second period, minus 50% in the later period. If you take the average, what you're gonna get is a 25% increase. But actually, revenue didn't increase, right? So over the period, revenue actually went back to 100. If you use geometric mean, okay, it will take into account the compounding effect, and what you will find is that growth is 0. So the reason why we use geometric mean is because it takes into account the compounding effect. Arithmetic mean doesn't. Okay, the difference between the two is half of variance. Okay. Anyways, there are a couple of ways that you can calculate CAGR. The simpler way, in my opinion, okay, is you take this figure. This is the future value, right? The future value. You divide by the present value, and you take it to the power of how many periods? 2. Very good. 2. Thank you. 2. And you minus 1. Okay, and you get 5.5. And the formula is this formula, right? FV equals PV1 plus R to the power of T. Okay, and then you just find R, right? So R will be FV divided by PV okay, to the power of 1 over t minus 1. Okay, so you can use this formula, all right, for CAGR, for geometric mean. But since we've already calculated the annual growth rates in the period, okay, so we have 6.6, 4.4, we don't have to use that formula that I used just now. What we can use is we can use geomean. Okay, so geomean stands for geometric mean. When you type in, okay, you see that the computer guess, okay, what formula you want to use. So you don't have to, click on it on geomean. You don't have to click on it, or you don't have to write it in full. Okay, once the computer highlights the formula that you want to use, you can just click on tab. Okay, so you don't have to write it in full. You highlight the annual growth rates, parentheses, you minus 1. Okay, but if you click enter right away, okay, you will not get the right answer. Okay, when you click enter right away, you will not get the right answer. When you use geomean, you need to click Control Shift Enter. Okay, you need to press Control Shift Enter at the same time, and you turn this into percentage. Oh, right, +1, I'm sorry. Yep. So if you enter, okay, you see that it will not come out, well, the outcome will not come out. Okay, so you need to Control Shift Enter. Okay, and you turn this into a percent, 5.5. Do you get that? Okay, you can just give me a nod. Okay, do you get that? Good. Okay. So for the purpose of today's session, I'd like you all to round this to the nearest 2 decimal places. I think, well, the reason being, if you don't round up, the number becomes an irrational number. So you have like you have decimal places to the infinity. Okay, we want to be able to say the growth rate that we use for financial forecast. So let's put the growth rate as 2 decimal places. So you type round, okay, and Excel is very friendly. Okay, so when you type a formula, it will tell you what input to put. Okay, here it tells you to put the number, and this is our number. And the next one, they want you to tell the computer how many decimal places you want the computer to calculate. Okay, in this case, it's 4. As in 4, as in 2 decimal places. Okay, so you have 5.50. Okay. Did everyone get this? Good. Okay. So once we get that out of the way, you could just copy and paste the rest. Okay, since we are applying the same formula, so you just Control C, you highlight them. Okay, you press Enter. Okay, in this case, it doesn't work. You could just drag them down. Okay, and they will all have the same formula. All right. Okay. All right. So I want to make sure that everyone gets this. Okay. If not, I can repeat if you don't get this, because we will continue on with profitability. Okay. Is that all right? Okay. Now let's move on to the second analysis, and that is profitability. Okay. Here we have gross profit margin. Okay, and it equals gross profit over revenue. Right, 51.8. You do that for EBITDA, so everything is over revenue. EBIT margin is EBIT over revenue. Okay, net profit margin, the same thing. You have net income over revenue. Okay, we can just work on the first column first, and then we just drag the formula to the right. Okay, since we are applying the same formula. So far, so good? Okay, again, so what I just did is I calculated margins for gross profit, EBITDA, EBIT, and net profit. Okay, the formula is the respective margin that we want to find, okay, divided by revenue. So gross profit divided by revenue, EBITDA divided by revenue, EBIT divided by revenue, and net profit divided by revenue in the same period. Good? Now, return on asset. Okay, return on asset is a metric that is different from what we've calculated we've calculated earlier on, and the reason being it is a formula that consists of a PL item, profit and loss item, and a balance sheet item. And in most cases, what we would have to do is we will have to take the average of the balance sheet item. Can anyone have a guess of why we need to take the average of the balance sheet item? Anyone? Right, exactly. It's about the recognition period, right? As of, very good. Because the balance sheet item, okay, is an item that is recorded at a specific point in time. Okay, at a specific point in time. So accounts receivable, for example, could be recorded like one day before the accounting closes. Whereas PL items, okay, profit and loss items are being recorded over a period of time. In this case, it's 1 year. Okay, 1 year. So very good. Return on asset return here, we use net income. Okay, net income. So we scroll down to net income of this period. We divide by the average of the total assets, okay, between 2016 and 2017. Okay, so the numerator is net profit. You divide by the average of 2016 and 2017 total assets, and you hit enter. 3.6. You do the same for ROE. Okay, a similar concept. You take net income of the 2017 period. You divide by the average of the equity in the two periods. Okay. And now we have ROIC, return on invested capital. Okay, so asset equals liabilities plus equity, correct? Liabilities includes both non-bearing interest liabilities and interest-bearing liabilities. Okay, so invested capital takes into account only financing. Okay, only items that are used for financing purposes. So they only look at interest-bearing debt. Okay, only look at interest-bearing debt. We need to calculate invested capital. Well, I make it easier by calculating invested capital first, okay, in each of the period. So I took the liberty of calculating invested capital already, and that is, you take, I'm sorry, hold on. Oops. Okay, so total interest-bearing debt. Okay, total interest-bearing debt is OD plus current portion of long-term debt plus long-term debt. Okay, so these are interest-bearing liabilities. Okay, and I call this total interest-bearing debt, and invested capital would just be the sum of interest-bearing debt and equity. Okay, so this is our invested capital. Therefore, our ROIC will be net income of 2017. Okay, net income of 2017 divided by the average invested capital of 2016 and 2017, and you hit enter. Good. So far, so good. Okay. Here we use average. Okay, we don't use CAGR because CAGR is for growth purposes, right? Here is margin. We use average, so you just equal average. Okay, and you click enter. You got 52.6. Again, I just want to make it a nice number or easy to for easy communication. So I will round it to the nearest 2 decimal places. So you'll see that it's rounded to 2 decimal places. Okay, 52.56. 52.56. Since we are applying the same formula, you could just Control C, Control V, and this is the outcome. Okay, don't worry about this. The computer is smart enough to know that this blank space is not to be used. Okay, so you could just simply drag the formula. Okay, you don't have to do another formula for these two. Okay, even though there is no data here, the computer knows that, and will only take the average of these two cells. Good, very nice. So now we've I clicked this again. It's my habit to save every time I work on something. You know, like after every formula, pretty much I would save. So that's why I keep hitting on that function. Okay, sure. Okay, sure. Okay, so working capital. Okay, I'll explain working capital a bit more later on, but let us find the working capital requirements. DSO. Okay, DSO is the amount of time that the company receives cash from the client, right? So what we do is we take accounts receivable, and we take the average of the accounts receivable again because we are looking at balance sheet items and PL items in the same formula. So we need to take average of the balance sheet items, and that is accounts receivable. Okay, you divide by revenue, and you multiply by 365. Okay, it should be this one. Okay, 12.78. Okay, so I'll do that again. DSO, you calculate it as the average of accounts receivable between 2016 and 2017. You get that from your balance sheet. Okay, so 202 and 218, the average of these two numbers. You divide by revenue, and you multiply by the operating the number of days in the period, and that is 365 in this case. You hit enter, you get 2.78. Okay, so this is the number of days that you expect to get cash from your client. Good. Inventory. Inventory is related to cost of sales. Okay, so you apply a similar rationale. That is, you take the average of the balance sheet item, and that is inventories. Okay, you divide by cost of sales. Okay, you will get, well, I need to multiply by 365. Okay, the number of days in the period. So you get a negative number, right? And you get a negative number because your cost of, yeah. Revenue divided by accounts receivable. That would be AR turnover, right? That would be AR turnover, right? Okay. Yeah, you can calculate AR turnover and then use it later on to forecast your working cap, but you need to take the reciprocal anyways. Okay. So that is AR turnover. Here we're talking about DSO. Okay, so DSO is the proportion of accounts receivable to revenue. And inventory is negative because cost of goods sold is negative. Okay, so we need to put a negative sign in front, but we usually don't just put negative like this, okay, because it's a very small dash. What we do is we put a parenthesis, -1, parenthesis, asterisk, okay, just to make it clear, all right? You don't want to just put a dash, it's just very small. The person who comes back to review your model might not might not notice it. So you make it more obvious. All right, days of payable outstanding. For the purpose of this class, we will take the average of accounts payable. Okay, that's AP. And we will divide that by cost of goods sold. Okay, again, and multiply by the number of days in the period, and that is 365. Okay, we need to put a negative sign in front. All right, cash conversion cycle will just be the sum of DSO, DIO, and minus DPO. Okay, so the lower the cash conversion cycle, the better. Other current assets to revenue. Oh, I hit this again. Okay. Okay, current assets to revenue. I'll take the average of current assets. The average of current assets, and we'll divide by revenue. Okay, and current liabilities. So current liabilities can be, well, current assets. Current assets can be prepaid expenses. Okay, can be unbilled receivable. So receivables that you have not issued invoices, we call them unbilled receivable. They may be embedded in current assets. Current liabilities may be accrued expenses, so accrued salaries, interest, and tax. In this case, I assume that they are a proportion of cost of goods sold and SG&A. Okay, so you take average of current liabilities, okay, and you divide by the sum of cost of goods sold and SG&A. Okay, this is just an assumption. Okay. Okay, so far so good. And now we will apply the same formula for the next period. So you Control C and Control V. Okay. We want to take the average, and this will be the proxy that we will use. We get 12.56. Okay. It's just my personal preference to just round it to the nearest number, because I think it's easier to say, oh, DSO is 13 days, DIO is this amount of days without the decimal places. So for this purpose, I'm just going to round it up, as in round it to the nearest digit unit. Okay, so 13 days, 7 and 33. All right, and then we find the average of this. Round to 2 decimal places. Oh, I hit that again. I hit it all the time. Let me, can I just save this on, I'll just save this on desktop. Okay, so did everyone get that? Okay, actually another thing that we need is Capex to revenue. Okay, and that's under efficiency. We'll just do it very quickly. Capex to revenue equals Capex divided by revenue. Okay, and Capex is under the section of other key financial statements. Okay, divide by revenue. Okay, this is another item that we need for our projection. Okay, Capex to revenue. Again, it's just Capex divided by revenue. All right, and you take the average. Good. Okay, two more. Okay, two more to go, and then we will move on to calculation worksheet, and those two things are effective interest rate. Okay, this is also another thing that we need. Interest rate is negative. Okay, so we need to put a negative sign in front. You multiply this by interest expense and the average of interest-bearing liabilities, which we talked about earlier on. Okay, so the average of interest-bearing debt. This is our effective tax interest rate. So interest expense comes from a bunch of financing instruments. Okay, OD, loans, bonds. This is just an effective. This is a summary, like an overarching interest rate expense. Control C, Control V. Okay, everyone get this, right? So it's just simply interest expense over the average of interest-bearing debt between 2016 and 2017. Okay, last one, and that is dividend payout. Dividend payout equals dividend that the company has given out to shareholders divide by revenue. Divide by net income. Okay, and you get 24.5 for the first period. Okay, and we find the average here. So you take the average. Good. Okay, any questions so far? Any questions so far? Because we are moving from this tab. Yes. I'm sorry. Effective interest rate. Okay, let me explain effective interest rate again. Effective interest rate is you take interest expense, okay, and that is 341 in this period, 2017. You divide by the average of 2016, 2017 interest-bearing debt. Okay, and you put a negative sign, a -1 in front, just to make it positive. Yeah? Do you get that? Okay, so yeah. Average days of sales outstanding, so DSO, right? Okay, so DSO. Oh, this one? Okay, it's just round. Yeah, I just round it to 1 unit, to the nearest unit. I just think that it's easier to to talk with clients, and that it's 13 days, it's 7 days, 33 days. Just for this purpose, right? I mean, if you could also not round it. Okay. All right. So is everyone ready for forecasting? Good. Okay. So if everyone is on the same page, I want all of you now to move over to calculation tab. Okay, calculation tab. So I took the liberty of linking the assumptions to the ones that we use or the ones that we calculated in the historical tab. Okay, this is how I structure the model. Okay, I have the assumptions at the top. Okay, and I have workings below. Okay, so these blank cells will be the cells that we'll be working on. Okay, so we have profit and loss, we have balance sheet, we have cash flows, we have cash injections, we'll talk about that. We have financing, working capital, fixed assets, other control accounts. Okay, so we have a number of sections, but we'll work on them one section by section. All right, now the assumptions that we use, okay, we have profit and loss, okay, that we need assumptions, we need working capital requirement assumptions, we need assumptions on fixed assets, okay, financing, and that's pretty much it for this model. Okay, again, the more information you have, the more detailed your model can be. Okay, for today's purpose is just going to be simplified this way. But it's simplicity without loss of generality, right? You can still use this and apply this knowledge to more complicated models. All right. Now let us work on forecasting the profit and loss statement. Now, 6260 revenue of 6,260 is brought over from the last period. Okay, so 2018. Here we are forecasting 2019 onwards, right? So we are using our 2016, 17, and 18 financial information to forecast 5 years down the road, right? Starting from 2019. Therefore, this column represent the numbers in the last period, and that is 2018. Okay, so this is being brought forward from this number on the historical worksheet. Now, going back to calculation, what we do is we assume, okay, that revenue is going to grow at 5.5% per annum, so equals the previous number multiplied by 1 plus CAGR. Okay, but we need to click F4. Okay, just lock it, right? Like the Chinese boy band, right? Okay, F4, right? 1 plus F4, and you click enter. You get 6604, right? Okay, GP margin. Okay, this is margin. Okay, this is not cost to revenue. This is margin. So if it's cost to revenue, you could just multiply this percentage by revenue and you get cost. But because this is margin, you need to take revenue, okay, and you need to multiply by 1 minus gross margin, okay, and you want to hit F4 and close the bracket. Now it returns a positive number, okay, so we need to put a negative sign in front. Okay, so far so good. This is GP margin, just so that you're not mistaken. It's not cost to sales. If it's cost to sales, you could simply just use cost to sales. But since this is margin, you need to take 1 minus gross profit margin to get cost of sales. SG&A. Okay, SG&A is not, or in most cases, SG&A is not related to revenue. Like they don't go hand in hand. Okay, or they go the same direction. If revenue increases, generally SG&A increases, but not by the same magnitude. So for SG&A, I assume that it's going to grow at its own rate. Here, it's going to grow at 3.4% per annum. So using the same formula as revenue, we take SG&A multiplied by growth. Okay, you lock this and you close the parenthesis. Depreciation, we'll leave that for now. Okay, we'll leave depreciation for now. We'll move on to other income. Okay, other income, you see that is 0% at the moment. And the reason why it's 0% is because I didn't link it to the previous spreadsheet. Okay, so for cell F20, okay, F20, you see that I haven't linked an assumption. So going back to historical, scroll down to common size, profit and loss. Okay, I have other income as a proportion to revenue here. Is in cell F126. Okay, on historical tab, other income or other expense is 0.7% of revenue. Okay, you see that in cell F126. You want to link, okay, this cell to that assumption. It's just an assumption that I make. Okay, so again, link that cell to F126. Okay, other income. Of course, if you have more information about what other income is, you could forecast other income, right? It could be interest income, FX gain, it could be parking, limousine, whatsoever. In this case, we are just assuming that it is a percentage of revenue, okay? So we link this cell to historical cell F126, cell F126 on the historical worksheet. Now, when we get that done, you see, okay, we have a figure here. We assume that other income is a percentage of revenue, so we log this assumption multiplied by revenue, and we get 44. Good. Please leave interest expense blank for the time being. Okay, we'll come back to this. And we have tax. Okay, corporate income tax is 20% in Thailand. So we will apply that to our model. We log 20% multiplied by EBT. And we have to make this negative sign. Okay, make this a negative sign. However, there may be a case where EBT is negative. Okay, when EBT is negative, then we should not be paying tax. So we need to make our formula adjust to that assumption. All right. So what we do is we say that we don't want if EBT is negative, we want it to be 0. Okay, we want it to stop at 0. It cannot go negative. If it goes negative, we will not calculate tax. So that's a max condition. That's a max function. You max corporate income tax multiplied by EBT and 0. Okay, so let's say this is a negative number. Okay, I'm just going to punch a formula in. I'm just going to plug in negative 100. It returns me a 0. Okay, so it doesn't calculate tax. Okay, so again, you need to make that condition as well, just in case. Okay, so far so good? All right.
I take a short break to see if I'm still recording. Just want to make sure. Maybe
Sure.
you've been doing all this. Okay.
Okay. Now we can copy and paste. Okay, so copy this column and drag them to the right. Okay, so Control C, you highlight all the way to column P and you hit enter. Now we have 2 items that we have not populated. Okay, and they are depreciation and interest expense. Let's talk about depreciation first. Okay, let's talk about depreciation first, and that is this row right here. Okay, this row right here. When we want to calculate depreciation, depreciation comes from, or can come from two places. One is depreciation on existing assets. So the company may have existing assets that it has not completed recognizing depreciation expenses. We need to take that into consideration, and we find that expense on the company's fixed asset register. Okay, fixed asset register. In this case, I don't have the fixed asset register for you, but I just gave you an assumption. Okay, so we want to scroll down all the way to fixed asset, and that is row 208. Okay, I want all of you to scroll down to row 208. Okay, here you will see row 221. Okay, it takes into account depreciation from existing assets. So let's assume that I got this from fixed asset register. Okay, well I didn't, I make the numbers up, but in reality, you have to get them from fixed asset register. Now, another channel that depreciation expense comes from is from new capital expenditure. Okay, new capital expenditure. So usually when you do financial projections, the company that you are valuing, or if you have the chance to talk with the management, they need to give you the Capex schedule. So they need to tell you how much they are actually investing. Okay, but if you don't have, then you have to come up with an assumption. In this case, we assume that the company is going to invest Capex as a percentage of revenue. Okay, we have 21.7% here. But before okay, we have actually half an hour. Okay, let's do the simple version. I'm not sure if it will be simple or not, but let me show you how you can do this. How you can do this before I talk about a shorter formula. If you have, okay, so this is period. Okay, period 1. Okay, you don't have to follow me, or as in, no, you have to follow me, but you don't have to work on this. Okay, okay, we have 10 periods. We have the year. Okay, so let's say we start from 2019 onwards. Okay, and I'm going to have start date. Okay, so this is 2019. Let's say I have end 2023. Okay, so useful life. Useful life will be 5 years. I have a capex of, let's say, 100. Okay, what I'm going to do next is I'm going to create a flag. Okay, a flag is like a dummy. Okay, it will take the value of 1 or 0. I'm going to have a flag for capex. I'm going to have a flag for DP. Okay, so a flag is just a dummy. Okay, it's just a dummy that shows that in this period you're going to have capex. If that's the period, then it will the number will turn out to be 1. If it's not that period, it will be 0. For example, capex, we want our capex to start in 2019. So we want to use the if function. If this number, okay, if our year equals 2019, we want the outcome to be 1. If not, we want it to be 0. So it's 1, of course, okay, because it's 2019. But you'll see that it's 0 for the rest of the period. If we change this to 2020, 2019 will not flag 1, it will flag 0, but it will flag 1 in 2020. Now we want to do this for Depre as well. So Depre will cover a period, well, a time frame, here 5 years, okay? So let's say we have 2019, we have 2020. Okay, I'm just going to show you the timeline here. We have Depre here. Okay, if we have capex here, we want to calculate Depre for this capex. Okay, but if it is, well, if it is here, if our capital expenditure is made in 2020, we still want to calculate. It's still within our period to calculate depreciation. But if it goes beyond, we don't want to calculate that. It might be a bit confusing, but let me show you the formula, and it might be clearer to you. Okay, give me 1 second. So what I'm saying is that I want depreciation, okay, to take place only between 2019 and 2023. Anything beyond that time frame, I want it to flag 0. Okay, so I want to write if, and there are 2 conditions here, right? You have 2019, 2023. So you have 2 functions, 2 conditions. So I will use and function. The year, okay, the year that we are in has to be greater than or equal to the start date, and I'll hit F4. This year, okay, has to be smaller than or equal to 2023. I'm going to hit F4. If that's the case, we want it to flag 1. If it's not the case, we want to flag it 0. So you can see that depreciation flag, okay, is 1 for 2019, 20, 21, 22, 23. What if we change this? If we change this to 2021, 2025, see that? The flag, the dummy will move, okay? So it turns out to be 1 over the period that we want to calculate depreciation. Beyond that, we don't want to calculate. So that's the formula we use. Okay, now we have capex. Now we want to calculate capex and Depre. Okay. Oops, Depre. Okay, so Depre in this case will be 100 divided by 5, right? Useful life 5. So it's a depreciation expense of 20 every year. what you do next is, okay, you multiply capex by the flag. Okay, so this will tell you when capex will come in. Okay, it will come in 2021. Okay, since we put 2021 here, and depre will turn out to be over our specified period, and that is this. So this is one way you can do depreciation. But by doing this, okay, you can only accommodate one capex at a time. What if we want to accommodate more capex? Like, what if we have capex every year? Then you might have to do this a lot of this, right? Different blocks. What we then do is we use sum offset. Okay, are you guys familiar with sum offset? Have you heard of this formula before? So what sum offset does is this. Okay, let's say I have a random number. Okay, I'll just throw you a random number here. Okay, give me one moment. Okay, so this is our period. Okay, so if we would, so this is our discrete number. Okay, this is discrete. Okay, you have 19, 67, 31. What if we want to sum? What if we want to take cumulative? Okay, we can do cumulative by just very simply use sum formula, and we lock the start cell. Okay, and we drag. So this will take the sum of this. This will take the sum of the 3 period, take the sum of the 4 periods. Okay. Another way of doing this is using sum offset. Okay, so sum offset function. So what you have is equals sum. Okay, you tap and you hit offset, and you tap again. So you have two formula. The offset is within sum. Again, the computer is very nice. It tells you what inputs to put. Okay, so you need a reference. So this is your reference. Okay, and you lock it. You don't need row, column, height. So just put comma for all of them. For width, okay, put 1. So width tells you that you are only calculating how many cells. Okay, so width of 1 means that you're calculating only 1 cell, and that is 19. If width becomes 2, you calculate 2 cells from the reference cell. Okay, you will get the same output. See that? Okay, so same output, just different formula, and it will turn out to be very useful actually. Okay, and we actually need to use it. And another way, okay, so you see that the reference cell is still at cell F23. We want it to move with our cell. You know, this is not pleasant. So what we can do is we apply the same concept, but instead of locking the reference cell, we don't lock it. Okay, we don't lock it, and we choose our width as 1. But what if we don't lock it? Then it will not calculate the way we want it to be. We need to put a negative sign behind, in front of width. So what that means is that it's taking a step back. Okay, so width -2 means it will calculate the 2 previous cells. Okay, with the reference cell being 1 cell. Okay, -3 means that it will calculate the reference cell and 2 preceding cells. You get the same outcome. So far, so good? Okay, in the interest of time, I will continue, okay, and I will use this formula for our capex, for our depreciation. So capex will be pretty straightforward, and that is 21.7% of our revenue. So you lock this assumption and you multiply it by revenue, which is way at the top, okay, 6604. What this is the amount of capital expenditure we will be having for the first period, for the first forecast period, that is 1,434. We want to calculate depreciation for this, okay? And since capex might come in every year, we cannot just take this and divide by 10. Okay, we need to use some offset. So equals some offset. Okay, our reference is this. We don't care about row, column, height. In this case, we care about width, and our width, we use negative of this period. And we divide by 10 years. Okay, so we get 143. But depreciation has to be negative, so we need to put -1 in front. Okay? So far, so good? All right. It gets a tiny bit more detailed, okay, in the sense that you cannot depreciate beyond the existing asset you have, right? If you have 100, you can only depreciate, well, if there's no salvage value, you can only depreciate it until 0. You cannot depreciate less than 0. It cannot be negative. That's the reason why we need to put a minimum, okay? A minimum of our existing asset. So that's beginning plus additional capex. It cannot go beyond, it cannot go below that. Okay, this is just in case. There are certain cases where it might go below that. Okay, you then just copy and paste to the right. Good? Okay, so if you can't really follow, you can take a look at the presentation again. But because in the interest of time, let me move on to the other sections. Okay.
Skip the cash flow. I want to use both the model.
Okay. Okay. All right. So now let us go to working capital. Okay. So we are done with actually going back to profit and loss, depreciation. You need to link it back to the bottom. Okay, so I haven't linked it. So you simply just have to equate this to the amount of depreciation we've calculated earlier on, and that is this portion of depreciation and the depreciation expenses on existing assets. Okay, Control C and Control V. Okay, drag to the right. Now, we want to work on balance sheet first. Okay, so that we can find a way to calculate interest expense. Now, let's go to working capital. Actually, it's something that we calculated earlier on. We're now doing the reverse. Just now we calculated DSO, DIO, DPO. Now we want to calculate the items. Okay, so for this, 13 days of DSO, we divide this by revenue, and we multiply by the number of days in the period. Okay, so this is a reverse of what we did. Oh, I'm sorry. You divide by the number of period. You divide by 365. I'm sorry, and you multiply by revenue. Okay, so it's the formula we discussed in a reverse. Inventory. Inventory is in proportion to cost of sales. So you take DIO, divide by the number in the period, okay, and you multiply by cost of goods sold, okay, and you want this to be a positive number. Okay, and since we are applying the same logic to DPO, you could just take away, you could just lock the column, okay, for number of days to lock the row, and L42 is cost of sales. Okay, cost of sales. Just lock the row as well, so that you can just drag. All right. Other current assets, percentage of revenue equals percentage of revenue, and you have cost. You have other current liabilities. Here we assume that it is a percentage of cost of goods sold and SG&A. Okay, and it shouldn't be negative. Okay, Control C, and you drag to the right. Okay, so far so good. Okay, now that we have working capital working capital items, I want you to look at the balance sheet. Okay, so cash, we will leave cash for the time being. Okay, the second item is accounts receivable. So this is just linking what we did previously. Okay, so link this to accounts receivable that we just calculated. All right, that's the same thing for inventory. Okay, same thing for other current assets. Okay, so what I'm doing right now is just simply linking the items to our output. Property, plant, and equipment, we have that already, and that is in the fixed asset section. Okay, you equate this to ending. Okay, you equate this to ending. All right, other non-current assets. So other non-current assets will be in a different section. Okay, will be in the last section. Here I have a control account for the last section. This is for non-current asset. Okay, non-current asset can be employee benefit obligation. You equate this to this cell. Okay, so we've populated pretty much all of them except cash. OD. Okay, now when we do financial forecasts, we like to have control accounts. Okay, control accounts, they work like this. You have beginning. Okay, you take beginning over to the next period. You add something, you reduce something, and you find ending by just summing them up. Okay, this is what we call a control account. When you think of control account, I like to think of Batman. The reason being Christian Bale. See, BALE. Do you see that? Beginning, add, last, ending. Christian Bale. Okay, so when you think of control account, think of Batman. Now, in this case, for the purpose of this model, we don't have any assumptions. We just assume that they're constant. Okay, we're not putting any assumptions here. So for the next steps, we will just be linking them. Okay. Oh, actually, accounts payable is something that we calculated earlier on in working capital. Okay, accounts payable. All right. So OD, we equate this to OD in the control account, the ending figure. We do the same for current portion of long-term debt. Okay, other current liabilities, that will be under working capital. Okay, subsequent debt drawdown, leave that for the time being. Authorized capital will be under financing section. So right, so it's here. Okay, L185. Okay, paid up capital. So all I'm doing right now is just linking. Okay, nothing fancy. Hold on. Paid up capital. Okay, paid up capital will be L197. Okay, paid up capital will be L197. And retained earnings will be at the top. Okay, so equals retained earning at the top. Okay. Now, looking at retained earnings, okay, retained earnings is L58. Okay, here we just simply have to populate the cells. So net profit would just be this figure, and dividend, okay, will be a percentage of income. Okay, and we assume it to be 29.7%. And we just drag the formula to the right. Okay, now for the rest of the balance sheet items, we've calculated pretty much all of them. Okay, you just have to Control C and drag them to the right. Okay, so I guess many of you are not following me now. Okay, all right, now we have income statement and we have balance sheet. What we need to do next, we need to determine cash. Okay, we have cash flows. So that's the reason why we need to do the cash flow statement. It's a bridge between income statement and the balance sheet. It's not complicated. Okay, cash flow statement is just a reflection of the activities that go on in income and balance sheet. We've been doing accrual, recording items on an accrual basis since the beginning. Here is just turning them into cash. Okay, net income, you equate that. Well, so there are three cash flows in the cash flow statement, right? You have operating cash flows from operating, investing, and financing. Okay. We will take a look first at operating activities. You equal net income to what we've calculated above. Okay, so that's 924 here. You want to add back non-cash items. So depreciation is a non-cash item. You want to add depreciation back. Okay, and you take that from here, from the income statement. Now this is tricky. Okay, AR. If there's an increase in accounts receivable, is that a cash inflow or cash outflow? When you have an increase in AR, it's an outflow. Very good. It's an outflow. Okay. So as a result, well, this is something that often get me. Okay, and I often cannot tie my three financial statements because of this. Okay, so you need to be very careful when you deal with asset items. If they increase, it refers to cash outflows. So here you take, oops. So for a change in AR, you take the previous cell minus the current period. Okay, you could also do it the other way around, where you have the current period minus the previous period, but you need to put a negative sign in front. Okay, so this is a cash outflow. Okay, same idea for inventory. If there's an increase in inventory, it's not a good thing. Okay, that means that you're not selling your stock, your goods. Current asset. Okay, same idea. Well, I actually could just drag the formula. Now, AP. Okay, so AP will be the opposite of asset items, right? So if there's an increase in AP, accounts payable is a good thing. You're not paying your suppliers. So an increase is a cash inflow. So this minus the preceding period. Other current liabilities. Okay, same idea. Is this one? Okay, so now we have cash flows from operating activities done. Good. Now we move on to cash flows from investing. Capital expenditure, you would just use the one that we calculated below, and that is in the fixed asset section. You equate this to here. You add capex, but it's an outflow, so you need to put a negative sign in front. Sale of fixed asset, okay, it will be a cash inflow. Again, it's in fixed assets section. It's a cash inflow. Here we do not have information on this. It's okay. Okay. And change in non-current asset. Again, this will be an outflow if there's an increase. But here there's no change. All right. So we are done with cash flows investing. Now moving on to cash flows from financing activities. When we do cash flows, what we're doing right now is an indirect approach. Okay, so we are actually populating our cash flow statements using the information we have in the profit and loss statement and balance sheet. So you could simply derive cash flows from financing from the balance, from the statement of financial positions. You have OD, okay? So change in OD, change in current portion. Okay, it's all zero because we have no assumption. Okay, subsequent debt drawdown, leave it for now. Long-term debt is a non-current item. Long-term debt, no change as well because we've made no assumption on this. Paid up capital, no change. Okay, and we have premium and dividend. Okay, so dividend will be up here. Okay, so far so good? All right. Now, moving on to net change in cash, okay, is the summation of the three cash flows activities. Okay, so cash flows from operating, investing, and financing. You sum all of them up, you get net change in cash. This is just, I'm just linking the item to this cells, okay? Nothing fancy. Good. Next up, okay, we want to determine, so on our balance sheet, we still have cash, okay? Cash we have not populated. So we want to calculate cash. And we do that again, we want to find beginning cash and how much, cash flows have changed during that period. So beginning cash refers to the cash at the beginning. You can get that from the balance sheet, and that's 1051 in this case. Okay, so it's coming from the previous period. CFO plus CFI. Okay, CFO, Chief Finance Officer plus CFI. Okay, you get this. And then you want to get rid of all the financing activities, and to determine whether you have a cash shortfall or not. Cash shortfall means deficiency in cash. You don't have enough cash. Your balance sheet cannot have a negative cash outstanding, right? So I'm just linking cash flows from financing here. Okay, I'm just linking them. Nothing fancy. Long-term debt. And then the rest, I can just scroll down. Okay, good. Now we have a minimum cash requirement. Okay, so this may be the case in some situations where you need to have minimum cash requirement. It's zero at the moment, and the reason being I didn't tie it with something. Okay, give me one moment. Let me tie this. Cash to revenue. Okay, so we have cash to revenue. We have cash to revenue of 16.3%. What that means is that we assume that the company needs to have at least 16.3% of revenue in cash in every period. This is just an assumption, okay? And as a result, okay, we calculate that out. Okay, so 16.3%, we multiply that by revenue in the period. Okay, 6604, and we get 1077. Okay, so 1077 tells us that the company needs to have at least 1077 million baht in its balance, in its statement of financial positions. So we want to identify whether the company has a shortfall in cash or not. Okay, we calculate, we take cash and we minus minimum cash requirement. So in this case, there's no shortfall, right? No shortfall means that there is no need to draw down cash. Okay, draw down is not you wad down. Okay, you draw down, you raise financing. Okay, you take out a loan from the bank. or OD. So we have to make a condition here. Okay, so we say if. Okay, we say if this number is negative. Okay, we want to raise this number. We want to take out a loan at the amount of this number. Okay, but if not, we want it to be 0. Okay, so we can use if. We can also use minimum. So minimum 36 and 0. So what that means is that if it's negative, let's say if this is negative 100, this will turn out to be 100. Okay, I need to put a negative sign in front. So what that means is that we need to borrow 100. Okay, we need to borrow 100. In this case, it's not. Okay, let me drag this to the right. Oh, I haven't dragged cash flow statements. Okay, give me one moment. Okay, now what we have here is we have, well, let me see. Okay, now I want all of you to be at row 63. Okay, row 63. Cash, you want to equal cash to this row. Okay, to row 160. Okay, just do that for the time being. Okay, so we have cash there. It's just linking. Okay, in this case, there's no need for cash drawdown. Okay, since we have positive cash. All right, we are now at 402. Okay, so we are running a bit late, but okay. Another thing that we haven't populated on our income statement is the interest expense. Okay, interest expense will be taking effective interest rate, and you divide by the average of interest-bearing debt. Okay, the average of the interest-bearing debt between this period and the preceding period. So it has to be a negative figure. So you put -1 in front. Okay, you log our assumption of 3.7%. You divide by the average of interest-bearing debt. Okay, and we have that on row 92. Okay, you highlight the average, you put a parenthesis, and you click enter. Oh, I'm sorry. Yeah, I'm sorry. Multiply. Right, very good. Yes, that means that you are listening. Okay, and you control C and you drag the formula to the right. Very good. Okay. So now we have pretty much all of the items. One last thing is you will notice that our balance sheet is not balanced. And it's not balanced because when you go to the cash section, okay, and that begins at row 131, you will see that on row 146, okay, we actually have a cash shortfall. Okay, so for the period of 2019, we have cash flows of 905, okay, but we need minimum cash requirement of 1077. Okay, that is our assumption. That means that we need to draw down. Okay, we need to take out loan. Okay, take out OD. Usually, it may be the case that you are given a debt schedule by the management. Okay, that means that they will tell you when they're going to repay debt, when they're going to take out loans. But in certain cases when you don't have, and there's such a case, you need to construct your financial model in a sense that in a way that it will calculate cash injection automatically. So that's what we're going to be doing very quickly. What we do here is we say we need cash, we need subsequent cash drawdown, right? We need cash subsequent drawdown. We have a control account. Here this shows the beginning value, and that's 0. Okay, at the start we don't have subsequent cash drawdown. Here we say that we need an additional 173 million baht. Okay, 173. But we also have an account that is less, which means that if we have enough money, we want to repay our subsequent debt. Okay, if we have money, if you have cash, we want to repay that. That's our assumption. So what we do is we say that if our cash, okay, if our cash after minimum cash requirement, okay, is positive. If it is positive, we want to pay. Okay, we want to pay. If not, we want it to be 0. Okay, so this is 0, of course, because we don't have money, right? It's still negative. Our cash after minimum cash requirement is negative. So in the last period, it's positive. So that means that, hey, we can actually repay, and we repay 349. Okay, but repayment means cash outflow, so we need to put a negative sign in front. Now, one last thing is that there's a possibility, well, not a possibility, but we cannot repay more than the cash we have on hand, right? If we have 100 and we don't borrow, and we cannot return the money more than 100. We only have 100 in the case we don't borrow. So we need to put a minimum condition. So minimum of cash we have on hand, and the minimum of the amount of subsequent debt we have. Okay. Exactly, because just now you see this, we only have 36, right? We only have 36 on hand in our balance sheet, but here we are repaying 349, and that is not possible. We only have 36 on our statement of financial positions. Okay, so we need that minimum condition. If you go up to the balance sheet, it's still not balanced. It's because we haven't put our we haven't linked our subsequent debt drawdown. So we simply just equate this to our drawdown. Okay, very nice. And this is the part that I like to show you, and it shows that it warns us that there is a circular reference. Okay, you click OK, and it will show you this, that there's circular. Why is there circular after I put subsequent debt in the balance sheet? Exactly, right. That's what circular means. It means A references B, B references A. Okay, if you have this automatic drawdown, what that means is that if you draw down, it will impact your interest expense, right? Since we calculate interest expense using the average of the debt of the interest-bearing debt. When that happens, interest expense goes up. Interest expense goes up, net income goes down. Net income goes down, cash goes down. Okay, cash goes down means we need to draw down more. We draw down more, it goes back to interest expense increases. You know, it's a circular. So to avoid circular, you could just not do average. Okay, you just tie interest expense to the beginning debt amount. In that way, you will not have circular. Another way is if you think that you want this circular to happen for accuracy, you go to the function, or you go to the checkbox that I told you to take out earlier on at the start, and you check it. Okay, you put a check on it. So you go to option. There's a pop-up. Okay, on the pop-up, you go to formula and you check enable iterative. So in this case, the computer will recal, okay, until it reaches until it gets an outcome that is satisfactory, and you click OK, and you solve that, and our balance sheet is should balance. Right. I linked the wrong one. Hold on. Can anyone tell me why we don't want to have circular on our model? Is circular a good thing? I'm sorry?
I mean, I have faced that when I have circular problem, the value in the referential, first one will become zero and then we face the problem.
Okay. Right. So there are two disadvantages of circular. One is inefficiency. Okay. It makes it is memory intensive. Every time when we make changes to our model, the model will recount all the time. Okay. So for best practice, we usually don't want this to happen. Sometimes people want accuracy. So okay. Another disadvantage is that it's risky. Sometimes we have unintended circular. We don't want that circular, but because we check that box, Excel loses the ability to raise a red flag over unintended circular. In this case, it is intended, right? I did this on purpose, so it's okay. But there are certain times that this might not be on purpose. It might actually be a formula error, and the Excel will not detect it. Okay. So that's pretty much it. We don't have enough time. I actually wanted to show you scenario. Okay, so here what I showed you here is we have assumption, just one assumption, and we assume that this assumption applies to every period. It could also be the case that we want to input different assumption in different period. We could do that as well. We could set up scenario, okay, where we have worst case, base case, and best case, and you use choose. Okay, that is for flexibility. I wanted to show you that, but in the interest of time, we don't have. But that's pretty much it. I hope that from here you will have an an overarching understanding, okay, of how financial construction can be made, and also have a recap about the interaction among the three financial statements, and also how to go about doing a financial model. All right. With that, thank you so much, and I hope that you will do well in the course. I heard that it's going to be pretty challenging, but I'm sure you will learn a lot over these 2 months. Thank you.